Ladies and gentlemen, bubbles have three characteristics. They tend to be a single cycle, boom, then bust, relatively short in duration, and crash back down to the baseline, which is either zero or the inflation-adjusted place of where they were before the boom. The Dutch tulip mania was like this. So was the housing bubble. So was the dot-com bubble. And so was pretty much every other bubble ever. So what about Bitcoin? Well, Bitcoin, it's actually hard to see the price cycles because it's increased such radically in value over time. So we're going to use a logarithmic scale to look at what it looks like on a price cycle where you go from $0 to $1, then to $10, $100. It's called the logarithmic scale, which is often used for assets with this level of upside. So in the first price cycle, Bitcoin went from about 5 cents up to $32, back to $2. Now, if we were having this debate in 2011, you could be forgiven for believing it met 2 of the 3 criteria of a bubble, except that it landed at a price that was 40 times as high as the 5 cents that it started at. What happened next? It didn't go to 0, it went up to $1,200, came back to 92, meeting now none of the criteria of a bubble. Then what did it do? Well, it zoomed up to $19,000, down to $3,200, meeting, once again, none of the criteria of a bubble, 35 times the previous low price. Then it zoomed up to $69,000, down to $15,000, once again meeting none of the criteria of any historical bubble we have ever seen. Bubbles look like the bottom left of this chart. They do not look like the orange line.